It's my great pleasure to welcome Neeltje van Horen to give today's seminar. So Neeltje is Senior Research Advisor at the Bank of England. She's also a Professor of Financial Economics at the University of Amsterdam. And she used to be a colleague of mine, and she's someone whose work I admire greatly. So Neeltje, it's really fantastic to have you here to give today's talk. Before I hand the floor to Neeltje, just to go over the usual kind of format of the seminar. So if you have questions that you'd like to pose to Neeltje while she's speaking, please put them in the Q&A boxes at the bottom of your screen. I can relay them directly to Neeltje, or I can hand the mic to you and you can ask directly yourselves. We'll also try and leave 10 to 15 minutes at the end for discussion. With that, over to you, Neeltje.
Great, thanks a lot, David. Let me just start with sharing my screen. Yep. Good. Well, it's a great pleasure to be here. Thanks a lot for inviting me to present this paper. It's joint work with my colleague Belinda Tracy, who's also in the audience. And it's called Down Payment Constraints, Homeownership and Household Spending. Importantly, the views that I express are those of me and Belinda, and not necessarily those of the Bank of England or its policy committees. So this graph is probably not going to surprise you very much. What we observed in the last 20 years is a sharp drop in home ownership of young households. This graph shows the home ownership rate of different age groups in the UK. The blue line is the age group of the 25 to 29-year-olds, the green line of the 30 to 34-year-olds. And what you see is that in both cases, there is a big drop. And this drop has gone faster after the global financial crisis. Well, there are several reasons why we've seen this happening. One, there is because we've seen weak earnings growth, and specifically weak earnings growth relative to how fast house prices have risen. And this went in combination with a tightening of lending standards after the financial crisis. A key obstacle, what seems to be going on for young households, is that it's hard for them to save for a down payment. This is already a barrier in normal times, but even more so when credit conditions tighten. When credit conditions tighten, for example, we've seen it after the financial crisis, we see that lenders quickly pull their low down payment mortgages or high LTV mortgages from the market. And we've seen it happening during COVID now as well. So the blue line here is shows the number of low down payment mortgages, and the red line is the number of all mortgages with a down payment of 10% or more. And you see that the mortgages with a low down payment, so with 5% or less, they collapsed after the financial crisis and they didn't recover afterwards. And you see that they only start increasing again after around 2013, and that's exactly when the Help to Buy program came into effect. And this pooling of low down payment mortgages from the market does not affect all buyers equally. It especially seems to affect first-time and young buyers. So what this graph shows is the share of low down payment mortgages, so 5% down payment mortgages, just before the financial crisis. And you see that on average, 25% of the mortgages issued at the time were with a down payment of 5% or less. But if we look at first-time buyers, we see it's about 45%. And that compares to home movers, which only have about 15% low down payment mortgages. If we compare young and old buyers, you see that young buyers on average have about 30% of the younger buyers had a low down payment mortgage, while 20% of the older buyers had a 12% of the older buyers had a low down payment mortgage. So if lenders pull low down payment mortgages from the market, this especially affects first-time and young buyers. So some important policy questions that policymakers around the Western world are facing is how to make housing more affordable for young households. Which policies are effective, and how do these policies impact the wider economy? So what we're going to do in this paper, we're going to study the effectiveness of a policy that specifically targets the easing of down payment constraints. We're going to look at how this affects home purchases and specifically how it affects home purchase of younger households. And then we're going to see how it affects household spending as well. And the UK provides us with an ideal setting to test for this, because in 2013, the UK government introduced this Help to Buy scheme. And the Help to Buy program was one of the biggest housing interventions in the UK housing market. And it allowed people specifically to purchase a house with only a 5% down payment. And this went against the backdrop of a market of low down payment mortgages that had virtually collapsed. The second reason why the UK provides us with an ideal setting is because we have really detailed data. We have detailed data on mortgages. This has been used extensively in the literature, but also detailed data on consumption. The Living Cost and Food Survey is often used also in the academic literature on studying various impacts of various questions on consumption. But we also introduced some new data on car sales. So before I go into the details of the paper, let me run quickly through you the main findings of it. So the first finding is that Help to Buy indeed led to an increase in home purchases. And we estimate that it led to about 290,000 additional homes that could be purchased because of the program over the course of 2013 to 2016. That's about a 10% increase in home purchases. The second benefit is that the main beneficiaries of the program were, on the one hand, first-time buyers. So that means that the program also led to an increased transition into home ownership. And on the other hand, it was young buyers. So almost all of the houses purchased were done by young buyers, so buyers under the age of 40. And this included both first-time buyers, but also home movers. And finally, we document that Help to Buy led to an increase in consumption. We find in regions where Help to Buy was regions that were particularly exposed to Help to Buy, that also in these regions, non-durable consumption increased. And this is also non-durable consumption, excluding housing-related consumption. And this was particularly driven by younger households. And finally, we find that also in these regions, the number of new cars were purchased also increased. And this seemed to have been driven by loan-financed car purchases, so not outright purchases. So the key things that I would like you to take away from this paper before I go into the details is that we show that when governments ease down payments constraint, this can boost both home ownership and consumption. This suggests that for young households, saving for a down payment acts as a binding liquidity constraint. When they want to buy a house, but they have to pay rent and at the same time save for a down payment, that takes more out of their income than having to pay the mortgage and additional housing costs. So when they can move houses, that actually frees up discretionary income that they can spend on food, restaurants, clothing, etc. instead. So we document another channel through which home ownership and consumption can interact. So let me first start with showing you how binding a down payment can be as a constraint, because it was actually something that really surprised us. We did not envision the real strictness that a down payment, the big of a constraint a down payment can be. So a mortgage, as we all know, can be constrained by the loan-to-income ratio and the loan-to-value ratio. It can also be constrained by the payment-to-income ratio, but let's set that aside for now. So the mortgage is ultimately constrained by the LTI and the LTV, and therefore the household's income and its down payment. And the maximum house price that the house can afford will be the minimum of, on the one hand, the LTI constraint, its income constraint, or the LTV, the deposit constraint. And there is an important difference to keep in mind. The LTI, tightening of the LTI is a linear constraint, has a linear effect on housing affordability, while the LTV is a non-linear constraint. It has a non-linear effect on housing affordability due to its leverage effect. Let me illustrate this quickly by an example. Suppose we have a household with an income of 45,000 and a deposit of 10,000. This is roughly the median income and deposit of households that were buying a house with a low down payment just before the financial crisis. So if you only take the LTI constraint, and the LTI is 4.5, the maximum affordable house for this household would be 202 or 500 pounds. If you ease the LTI constraint to 5, this household can purchase a house that is a little bit more expensive, 225,000. Now let's have a look at the LTI constraint. If the LTV constraint. If the LTV is 90, this household can purchase a house of 100,000 pounds. If the LTV is 95, then this household can purchase a house that is way bigger, can purchase a house of 200,000. So there are 3 things to take that this simple example shows us. So the first one is that for most of these kind of young first-time buyer households, the LTV is the binding constraint, not so much the LTI. The second observation is that if we ease the LTI constraint from 4.5 to 5, this has only a small impact on housing affordability, provided that the LTV is not the binding constraint. If we look instead at the LTV constraint, and that is eased from 90 to 95, then you can see that that can have a large impact on the maximum affordable house, so it can generate large behavioral responses. So this is exactly where the Help to Buy program came in, because the objective of the Help to Buy program was to increase housing affordability for buyers with limited savings and had a hard time to save for their down payment. And as it allowed people to purchase a house with only a 5% down payment, which was not possible at the time, or very hard at the time. The program was introduced in April 2013, and it had 2 main schemes. One was the equity loan scheme, and one was the mortgage guarantee scheme. So let me run you quickly through the things that are similar and different from the 2 schemes. The equity loan scheme was first introduced. It was introduced in April 2013 and is still running right now. It's supposed to end in March 2021, but likely to be extended. That will be announced later this week. The mortgage guarantee scheme was introduced in October 2013, and it stopped in December 2016, and the government is again thinking of reintroducing it now due to COVID. Both programs allowed households to purchase a house with a 5% down payment. Under the equity loan scheme, the government takes equity of 20% of the house. On the mortgage guarantee, the government guarantees 20% of the mortgage made by the lender. Under the equity loan scheme, only new builds qualified. Under the mortgage guarantee scheme, both old and new builds. But in both cases, the value could not be more than 600,000, with less than 300,000 in Wales. All borrowers, both first-time buyers and home movers, could qualify. Buy-to-let was not allowed under it. And the qualifying loan had to have an LTI of 4.5 or less. And for the equity loan, that ratio excludes the equity loan component. Under the mortgage guarantee scheme, that ratio includes the mortgage guarantee component. So that's the Help to Buy program in a nutshell. So this graph shows in a very aggregate way the effect that Help to Buy seemingly had in aggregate on the mortgage market. The right line is the share of low down payment mortgages. The blue line, the number of low down payment mortgages. The light shaded area is the Help to Buy, the full Help to Buy exposure period. And the dark shaded area is the period where both the equity loan and the mortgage guarantee scheme are in effect. And that's also the period that we are going to focus on. And what you can see is that really the increase in both the share as well as the number of low down payment mortgages start to really, that is exactly at the same time as that the two schemes came into effect. It's still relatively marginal in 2013, but when the programs became more well known, you can see that it really started to pick up and stayed quite high over the whole period. So these aggregates suggest that the program had an effect. And indeed, there were over 200,000 Help to Buy mortgages signed. However, in order to properly evaluate who benefited from this Help to Buy program, whether it really led to an increase in home sales that specifically benefited young and first-time buyers, and what the effect is on consumption, we need to have a counterfactual. So that's where what we're going to do in order to generate that counterfactual is to...
Neeltje, could I interrupt you and just ask you one clarification question at this stage? This one is from me, actually. So would you mind kind of winding back to your nice charts with the share and the number? I guess I was wondering about, it's interesting that on the far right of the charts, if I've understood you correctly, when the mortgage guarantee bit of the scheme was removed, these numbers stayed kind of high. So it feels like this program kind of gave the market a boost, and then it kind of stayed at this level in terms of the availability of loans to these customers. I guess my question is that the right interpretation? And could you tell us anything about the share of the two, like the equity one versus the mortgage guarantee one? Were they both as important as each other, if that makes sense?
Yeah, no, it's a great question. It's exactly the reason that the government stopped the mortgage guarantee scheme in 2016 and why it's thinking of introducing it now again during COVID is because after the program came into effect, what started to happen in the market is that some banks started to issue low down payment mortgages or open up the market themselves. Not all banks wanted to participate in a mortgage guarantee scheme. And at some point, there was just enough availability in the market that the government help was not needed anymore. So basically, the market took the role of the government in 2016. The equity loan scheme maintained. So in a way, you can think that the markets did not need the guarantees anymore, or did not want to pay for the guarantees anymore, and therefore that was not necessary. And the interesting thing is that it could stabilize without the government interference.
Yeah.
After the COVID shock hit, you could see exactly the same thing that happened during the financial crisis. You see happening again. All banks pulled the 95% LTVs from the market, and even the 90, and in some phases even the 85 LTVs. So in a way, the government is reintroducing that scheme, and I don't know exactly its thinking, but I can envision that they think in the same way as they did now. That they hope that introducing these guarantees, that eventually the market will start doing it itself again after the shock has surpassed.
Yeah, I see. Thank you. That's really helpful.
So the way we want to see how to create a counterfactual, what we're going to exploit is that there is actual geographical variation across the UK in exposure to Help to Buy. And it's a similar strategy as been used by, for example, Mian and Sufi and Berger, Turner and Swig, who either test for the Cash for Clunkers program in the US, or the first-time buyer credit, also in the US. And the idea that we are going to exploit is that even though Help to Buy was national in scope, it had a specific target. It had a target of low down payment buyers that had a hard time saving for a down payment. And these type of buyers are not randomly spread across the UK. They tend to be attracted to specific areas where the housing supply is better suited because the type of apartments or houses, the price of houses, but also areas with certain local amenities. You could think about pubs and restaurants, parks, schools, anything that attracts younger households. And these local characteristics, they tend to change rather slowly. So one could argue that an area's historical attractiveness is a very good proxy for the number of potential low down payment buyers that are wanting to buy a house in that area as soon as Help to Buy was introduced. So the way we're going to measure exposure, we take that idea and measure exposure by taking the share of low down payment mortgages in a particular district, and we measure the share of the low down payment mortgages over the period 2005 to 2007. So over the period just before the financial crisis, when this market was arguably the least constrained. And we're going to do that for about 380 districts, and these are the local authorities in the UK. And this is the closest to an economic integrated unit in the UK. And the idea that we're going to exploit is that we compare areas with few with areas with many low down payment buyers, and the areas with few can function as a control group, because in these areas, buyers very unlikely react to Help to Buy. So anything that we observe in terms of home sales in that market would be unlikely to be driven by these low down payment buyers. So, as I said, the UK has very, very good mortgage data. It's the product sales database, and it's a regulatory database that has been provided, or that is collected by the FCA. And it captures the universe of UK regulated mortgages from 2005 to present. And it has a lot of detail, not only on the mortgage, but also on the borrower and lender characteristics. And specific for our purpose, the data includes information on the house price, the loan value, so that gives us the down payment that is used, the postcode, whether the household was first-time buyer, the age, and also the income level. And that gives us enough information to see what happens when Help to Buy was introduced. So just to give you an idea of the map of how this Help to Buy exposure measure looks across the UK, and you can see there is quite a lot of variation across the UK. The light areas are areas with little Help to Buy exposure, so these are not very attracted or were not very attractive areas for buyers with a low down payment, and the darker areas are the very attractive areas, so with high Help to Buy exposure. So before I go into the regressions, let's give some flavor of the performance of this Help to Buy measure. David.
Could I convey another question to you? So this one is from our colleague Gulchin Ozkan, who she's posted it in the Q&A. So she asks, she notes that another key macro developments during this period was the growth in employment following the huge rise in unemployment after the financial crisis. And she thinks you'd expect that rise in employment to have a similar impact on home ownership and consumption. Are you able to control for that effect?
Yeah, no, that's an excellent question. And indeed, fortunately, because the UK, I did not even mention that yet, but the UK also has a lot of very good regional data on employment, on rents, on income, on so many different house prices. So that allows us to actually, at a very, very granular regional level, to control for all these factors. Because you're right, Help to Buy exposure is correlated with these measures. I will show that in a second. But luckily, fortunately, because this very good data that the ONS collects, we are able to control for that.
Very good. Thank you.
I thought somebody raised a hand, but I wasn't sure.
No, I don't think so.
Okay, great.
Go ahead.
So just to before I go into the regressions, just to show you a little bit of a flavor of the performance of our Help to Buy exposure measure. And on the horizontal line, you have our Help to Buy exposure measure, so the pre-crisis share of low deposit mortgages. On the vertical axis, we have the ex-post share of low down payment mortgages, so between 2014 and 2016. And you see there is a very strong positive correlation between the two. Also, if we look at it from a time perspective, you see that our measure really picks up very well this time dimension. So the red line, the red dots represent a low help to buy exposure area in the 25th percentile of the help to buy exposure distribution. The blue line is a high help to buy exposure. And the dark area is, again, the period where both the equity loan and the mortgage guarantee scheme were in effect. And you see that before the help to buy came into effect, we have very similar trends in both regions. And then as soon as help to buy starts to become more and more present, you see there is a very big difference in the number of low down payment mortgages issued in a high help to buy exposure area relative to a low help to buy exposure area. But of course, we have some identification challenges, which was very correctly just raised. Help to buy exposure is correlated with other district characteristics. We do find it's positive correlated with unemployment and with population. Is negatively correlated with income, rent, and with housing prices. But that does come with a clarification that it's not necessarily going to bias our estimate upwards or downwards. But still, we need to make sure that this is not what we're picking up. So what we're going to do, or what our empirical strategy allows us, is to first to include district fixed effects. So anything that's time invariant and how the districts differ because it's an urban or a rural area, for example, that we control for. Then we can control for all these variables at the time varying level at the very narrowly defined district because the UK has such good data for that. We can test for parallel pre-trends. And finally, in some of our analysis where we differentiate in terms of borrower type and other levels of heterogeneity, we can even include district time fixed effects. So that controls for all observable and unobservable time varying differences across industries. And that's it should be a very strong control and lessen a lot of the potential confounding factors. So before I go into the regression, let me recap why we think Help to Buy has actually an impact on the housing market. So Help to Buy makes it easier for people to buy a home with a 5% down payment. But this can have three effects on demand for housing. The first one, the one that most people probably have in mind, is that renters can now buy. So that would be what you would call an extensive margin effect. Another effect could be that it allows households to pull forward the purchase of a house using their existing deposits. So that was what we call a timing effect. But it could also lead people to just buy a more expensive house, to switch from a high to a low down payment mortgage. So instead of buying a house from 100,000 to buy a house of 200,000, but it's not leading to additional people buying a house. This would be an intensive margin effect. So if Help to Buy would only if it leads to effect 1 and 2, it would lead to an increase in home sales or home purchases. And if this is done by first-time buyers, then it would also lead to an increase in home ownership. So that's what we're going to test now. So first, I want to show some of dynamic effects, just to see that it really is this timing effect that we're picking up. So on the left-hand side of this regression, we have the number of home sales in a local authority, in a district, in a particular year. And on the right-hand side, we have our Help to Buy exposure measure, and we allow that measure to have a different effect for all years from 2010 to 2016, where 2012 is the baseline year. At the district level, we control for unemployment, population, income, rent, and also house prices. And then we include district fixed effects and time fixed effects. And what we get from this estimation is this graph. And it shows us two things. One, it shows that if you go from December, say the point from December 2013 to December 2016, you'll see that there is a positive significant effect of Help to Buy exposure on home sales. So what we observe is that an increase in home sale in high exposure areas at the moment Help to Buy came into effect in 2013, and that effect becomes stronger over time. Importantly, we also do not find any pre-event trends. We see that the differential parameter, so the exposure, our exposure measure, doesn't explain any, doesn't give any information on the amount of home sales in a low versus high exposure area prior to Help to Buy. So this is an indication that we do not observe any pre-event trends. And this estimate controls for all these district level control variables. If we don't include these district level control variables, we find something very similar, which also gives an indication that our parameter is not really biased because of this. So on the economic significance, so this graph shows the cumulative increase in home sales due to Help to Buy, at least according to our estimates. And if we look at the last column, so the December 2016, we see that in a low exposure area, home sales have increased with 55%. In a high exposure area, it's in the 75th percentile of the distribution, it has increased with 120%, so a lot more. And if we calculate the aggregate effect, then our estimates show that Help to Buy has led to 290,000 additional home sales. So that's about a 10% increase in home sales. So that's your evidence on number, the effect, the extensive margin and the timing effect. But then we want to know that this is really driven by Help to Buy and not by easing down payment constraints and not something else that might still be picking up. So what we do now is we're going to focus on heterogeneous effects. And in order to do that, it's easier to look at a little bit slightly different specification. So we still have home sales, the number of home sales on the left-hand side, but then we have a post times exposure interaction instead of all these year dummies. And the post dummy is a dummy that is one if the period is 2014 to 2016. Our Help to Buy exposure is the same exposure measure. The district level controls are the same, and we have district and time fixed effect. So this is really just a pre-post type of diff and diff regression, but this allows us to look at different heterogeneous effects. So here in this table, what we're going to do is we're going to look at home sales of different LTVs. So the first thing I want to show you is columns 1 and 2, where we just take, again, all home sales in a district, but now we do the pre-post analysis. And the only reason I want to show you that is because that it shows, again, this positive significant effect, what you would already expect if you look at the dynamic effects. But also, if you look at the first column with no district controls and the second column with district controls, you see that the parameter goes down somewhat, but it's still very highly statistically significant. Then have a look at the columns 3, 4, and 5, because what we do here is instead of bunching all the home sales together, we now look at home sales by LTV. So we have 6 different LTV, so 7 different LTV categories, everything below 70, and then 70, 75, 80, 85, 90, and 95. And if you look at column 3, you see that the impact, just the average impact is positive and significant. But the interesting thing comes in when you look at column 4 and 5, because when you look at column 4 and 5, you see that this increase, this differential effect in home sales in high exposure areas is purely driven by the high LTV categories. And the parameter is the highest when it comes to the LTV with only a 5% down payment. So this gives us a lot more confidence that the effect that we document is really about the people are able to purchase a house because they can now buy a house with a lower down payment. And importantly, if you look at column 5, you see that that regression is with district time fixed effects. So that's a very strong controlling for everything else that might be going on. So the second thing that we want to show in terms of heterogeneity is the type of different buyers. So as I said, the Help to Buy program was particularly targeted people that have a hard time to save for a low down payment. And these are most likely either the first-time buyer or the younger buyers. Why is this? Well, first-time buyers have not had any home equity that they were able to build. The younger buyers, on the other hand, they often don't have a home. They often are first-time buyers. They also have lower income in general, and just have spent less time in jobs. So they have less time to actually save for a down payment. So we expect the effect to be highest for first-time and for younger buyers. In order to test this, we interact the post-time exposure dummy with a buyer dummy. And in the columns 1 and 2, this is the first-time buyer dummy. In columns 3 and 4, it's the younger buyer dummy. And those are buyers that are 40 years or younger. And what we see is that indeed, as we would expect, the impact is a lot stronger for first-time and for young buyers. And if we take these estimates back to our 290,000 additional homes, well, it means that 80% of those 290,000 homes were bought by first-time buyers and 92% by young buyers. So the program was really effective in increasing home sales of younger buyers. A lot of people always immediately what springs to mind is that, but what is the effect on house prices? Did this program not really lead to a high increase in house prices because there's suddenly more demand for housing? Well, we test for this. Instead of having now home sales as the dependent variable, we have house price growth as the dependent variable, and everything else is the same. And what we see is that there is indeed a modest positive effect of house price growth. We see that there is if we compare a high relative to a low exposure district, house price growth in the high exposure district is 1.4 percentage point higher. However, if you look at column 2 and 3, you see that the effect is a lot stronger in London than when you exclude London. And this has to do with supply restrictions that are much more present in London. And there is another paper that shows this as well, and they focus only on the equity loan scheme and focus very strongly on these supply restrictions, and they find similar results. So our results are in line with theirs. So there is some impact on house price growth, but it's quite subdued in all areas except for the London area. So in the final part of this talk, I want to take one step further. So we have shown that Help to Buy enabled liquidity constrained households to buy a home. But now we want to push it a little bit further, and we want to see, okay, what is the impact on the wider economy? And in terms of the wider economy, what we are interested here is the impact on household spending. And the reason why we're interested in household spending is because there is a lot of literature on the relationship between the housing market and consumption. A lot of the papers have focused on house prices and how that affect household spending, and when house prices increase, how that affect on the consumption of renters or owners, of young people and old people during a house price increase or a house price collapse. And another strand of the literature really focuses on mortgage debt and how that affects household spending, and particularly when households are faced with a shock. But there is hardly any evidence. The only paper we came across is about 25 years old, is how home ownership and household spending relate when people are able to buy a house because it has become easier, because the government eased their down payment constraint. So the relationship between home ownership and household spending via easing of down payment constraint can be positive or can be negative, theoretically. So on the positive side, one could argue that if your saving for a down payment acts as a binding liquidity constraint, then being able to purchase a home can actually free up discretionary income. Let me explain it a little bit. So if you have the idea to buy a house in the future, but you have to pay for your rent and have to save for your down payment, if that total amount of income that you have to use for that is larger than the amount that you have to spend on your mortgage plus any housing related spending, then actually being able to move from your rental to your purchased house can free up discretionary income and makes it easier for people to start consuming more food, go to more restaurants, etc. Another positive effect can be due to moving related expenses. It's well documented that people who move have to spend quite a lot of money on anything that's related to moving. So that can also be a positive effect on consumption, albeit temporary. A negative effect can be that if you have to spend a lot of money on moving related expenses, this can crowd out non-moving related expenses. And it's also possible that if you have more leverage, then that households, in order to service their current and future debt, might decrease consumption. So ultimately, it's an empirical question what we should expect when there is an easing of down payment constraints that lead to more homes being purchased. So the way we're going to do that is we're going to look at two sets of consumption data. On the one hand, we're having the living cost and food survey from the ONS. The nice thing about these survey data is that they have a very wide set of spending categories and also look at very different household types. We have young people, we have old people, we have renters, we have homeowners. It comes with the disadvantage that we only have 5,000 observations in a year, and that doesn't give us a lot in terms of spread across the country at these very narrow or small districts. So we supplement the information with the survey data with information on car sales that comes from the UK Department of Transportation. And the nice thing about car sales is that they are a key durable consumption good. They are a non-moving related expense. And these data capture the universe of new car sales, and they come from registration. And that gives us a lot of data points, which allows us to narrowly estimate at the district level. So let's first have a look at the survey data. So what we're going to do with the survey data, we're going to focus on non-durable consumption. And because we only have 5,000 observations in a year, we have to merge things together. And we do that on the left-hand side, we look at the consumption, the non-durable consumption of a particular birth year cohort, and we take 10-year cohorts over the period, for each year. And we do it at the Help to Buy exposure region. So not the Help to Buy exposure district, but we look at regions. And the way we construct regions is by taking all Help to Buy districts in the 10th decile of the Help to Buy distribution and lump them all together. And we do that for all the deciles in the Help to Buy exposure measure. So we are left with 10 Help to Buy exposure regions. So we take the consumption of different birth year cohorts in each year in those 10 regions. And we then interact again our post-dummy for the period 2014 to 16 on our average Help to Buy exposure measure. We can include a lot of cohort level variables. So to come back to the earlier question, we control in this case for the average age in the cohort, region, year, the household size, the income level, mortgage payments, whether they're what the share is of people that have a mortgage, and the share of outright owners. Then we include help to buy region fixed effects, time fixed effects, and cohort fixed effects. And importantly, we control for house prices at these regional levels, because it's very well documented that a change in house prices can also affect consumption. So what we find is that there is indeed a positive effect of help to buy exposure on non-durable consumption. So in this graph, in the first column, we take non-durable consumption but include moving-related consumption. And in the second column, we exclude moving-related consumption. And we find in both cases that there is an increase in non-durable consumption in high exposure regions after the introduction of help to buy. Well, you can then, of course, argue like, well, this could be consumption of anyone. Maybe it's consumption of old people for some reason. And we just documented that homes were being purchased by the young. So fortunately for us, because of the survey data allows us to look at different birth cohorts, we could actually differentiate between consumption by the older cohorts versus consumption by the younger cohorts. And what we see here, so we interact post times exposure with the younger cohorts, so the cohorts that were less than 40-year-olds in 2016. And what we see is that indeed this effect, this positive increase in non-durable consumption in high exposure areas is driven by young cohorts. I think there was a question.
Yeah, thanks, Neeltje. This is, I was going to put this in a second, but this is a question from Amit Steriol, who his point is, so he says, you ease potential endogeneity by adding district time fixed effects. Have you also shown that the parallel trends assumption holds? I think he notes that you probably have covered this, but could you just remind him how that's that assumption is catered for?
Yeah, no, it's a fair point. I haven't shown it here in the consumption data. I haven't. These are very new results, so I haven't tested literally yet for the pre-trend data. In the car sales, we have tested for that, and we see indeed that similar, like the parameter is only positive after the help to buy. So we only find a differential effect after the help to buy program came into effect and not before. So for the car sales, we definitely have no pre-event trends. The consumption, I'm pretty sure we don't have, but I have to verify that because this is just still we just finalized this last week. So this is really, really new, but it's a fair point.
Very good. Thank you.
In principle, with region time fixed effects, we do control for any differences, even at a region time level.
Mm. Thank you.
Thanks. So to end my presentation, I want to show the effect on car sales. So as I said, the positive effect of our car sales data is that we have a lot of observations. So that allows us to go back now again to our very narrow local authority district. The downside of car sales data is that we only observe the registration. So we observe the number of new cars sold in a district. We don't observe who bought them, how they bought them, how expensive the car was. Any of these things we can't observe. But we can go back to the district level. So we go back to the original regression. So instead of home sales in a district at a particular year, we now look at car sales in a district in a year. And again, the post dummy, help to buy exposure dummy, district time variant controls we included again, including, again, house prices. So whatever we document is not driven by an impact of increase in house prices on car sales. And what we find is, again, a very positive impact. So we find that car sales increase more in the high exposure areas after Help to Buy was introduced. We find the effect in all districts, but once we start to, we also find it when we exclude London. But in the third column, we only look at London itself, and there we find that the effect is insignificant. It's positive, but it's insignificant. And very likely the reason is that in London, especially, the new builds often do not allow people to have a car registered, or at least to have a parking spot. So they have to privately buy a parking spot, which is very often expensive. So that could be one of the reasons why we do not observe this effect in London. Another question that comes to mind is a logical question to ask is like, why do you even expect there to be a positive effect on car sales? I mean, car is the second most durable, most expensive durable consumption good that a household can buy. And if households have just purchased a house, why would they immediately purchase a car as well? Well, it's important to realize that in the UK, about 90% of cars are purchased with consumer credit. So it's not that people suddenly spend a lot of money on buying a new car, but they can spend an additional amount each month on a consumer credit allows them to drive a car. And we can't see that from the car sales data because we do not observe how the car is purchased. But the living cost and food survey can give us some indication. So what we do here is we look at the consumption of loan financed cars and cars that are paid outright. And we go again back at that regional Help to Buy exposure measure, and we observe that there is a positive effect of exposure, that we observe a positive effect on loan financed car expenditure, but a negative effect on cars that are paid outright. We have to take this with a grain of salt because there is not that many observations that people that have purchased a car in this survey, but it gives an indication that the effect we document on car sales is driven by cars that are financed with consumer credit. So what all this evidence on consumption seems to suggest is that Help to Buy not only had a positive impact on home ownership, but also on household spending. And it suggests the existence of what we have started calling the discretionary income channel of home ownership. If the down payment really acts as a binding liquidity constraint for a household, so if paying rent plus saving for a down payment is more money than paying for your mortgage and additional housing cost, then becoming a homeowner actually frees up discretionary income and allows people to spend more on food, on restaurants, on clothing, etc. And this finding or this idea is consistent with the Santander 2019 report, where they interviewed a number of aspiring home buyers. And 45% of these aspiring homeowners did say that they cut back on unnecessary spending and socializing in order to raise the necessary deposit. So our findings are in line with that report. So to conclude, we show that a policy that eases down payment constraint can boost both home ownership and consumption. So it suggests that for households, saving for a down payment can actually act as a binding liquidity constraint. And it highlights, so our results highlight another channel through which home ownership and consumption can interact. But let me stop with some words of caution. We, of course, look at one aspect of Help to Buy. We look at the direct effect on home purchases. We look at the direct effect on consumption. However, we do not look at a general equilibrium effect. Help to Buy could potentially lead to instability. If more households have a higher LTV mortgage, it makes them and the banks more vulnerable to house price decline. Plus, we also know that when shocks hit, leveraged households tend to decrease their consumption. So that's something that could have happened as well. Also, the positive impact on consumption that we document could be temporary. We can't really tell that from our findings, although I would doubt that if it's really about the discretionary income channel. And finally, what we test is the impact of the policy when it was introduced, when the economy was doing well. How it's going to be, how it affects the economy when it's introduced during a crisis, such as during COVID. That could be very different because other mechanisms might be at play. Thank you very much. That was all I have to tell.
Wonderful. That was fascinating. And the kind of results seem eminently plausible, which is always a nice combination. All right, we do have some questions. I'm going to ask you one myself to start with, and then I'll relay a couple of others. I was kind of wondering, I think you said early on that's like one of the design features of this policy was it applied only up to properties up to 600K, I think you said. And I was wondering if like another thing one could look at is whether there was any bunching of purchases around that number. That would kind of suggest this policy was binding and had quite a big impact. Before you answer, maybe let me relay a couple of others to you from the Q&A, and then you can kind of take, answer them how you like, basically. So one from Tommaso Aquilanti, he notes that it's an interesting point. So he notes that the stamp duty holiday that was introduced recently should have a similar effect, working through your liquidity, cash flow thing. So has any analysis been done on the impacts of that? Second question from Raghav Mathur, who thanks you for your talk and wonders about the impact of migration, especially young people moving away from cities to suburbs over the last year. What impact would that have? And then finally from Timothy Foreman, would it be possible to compare home buying behavior before and above the 600,000 cutoff? Okay, so similar to the point I raised with you, and to additionally control for time varying local factors. Let me, these are questions from the Q&A if I not relayed them well enough and you want to kind of glance over them.
Well, they're excellent questions, all of them. So this 600,000 threshold, we thought about that first. That was actually our first starting point. We thought, you know what, let's start with the 600 threshold and see if we can work with that. But it turns out that the 600 threshold is very high, except maybe in London, but in anywhere else, 600. These types of buyers, they don't buy houses of 600,000 in general. If we let's take London out of the equation, but in the rest of the UK, they don't. So this is not really affecting them. So in terms of, for us, empirical strategy, that was not the margin that we could exploit. Otherwise, it would definitely be a very interesting way of looking at it. So we did think about it, but we did not, from practical terms, it's just not, it's not a binding constraint, hardly. The stamp duty holiday, yes, there is a paper on it from Berg and Zwick. Exactly on that, the stamp duty holiday during or just around the financial crisis. And they do find a positive effect. I think it's actually really interesting. I do think the stamp duty holidays help, but they still loosening the down payment constraint has even bigger effect because it gives you a more, with the same deposit, you can do more. Although, of course, if you don't have to pay a stamp duty, then you can add that to your deposit, which allows you to buy a higher house. However, for many of these types of buyers, on average, the house price that they buy in the UK, they don't have to pay stamp duty. So for specifically these first-time and young buyers, they often do not really benefit from the stamp duty holiday because there is no stamp duty. Okay. So that's something to keep in mind. But indeed, a stamp duty also has a positive effect on home sales. That particular paper does not really look at young and first-time buyers and all that stuff, but just a general effect. And the migration point is a very interesting point. Let me just show you, because we did do some work on that. So one of the challenges to our identification could be that indeed people endogenously move to other areas to take advantage of Help to Buy, and that would make our control and treatment group a little bit tricky because they're not so clean. However, we started looking into this quite a bit, and it turns out that in the UK, again, let's take London a bit out of the equation, but the vast majority of moves are local. It's about 70 to 80% of the moves are local, and longer distance moves really have to do with employment and education. So going to move to a city from your parent home because you go to university, for example. But still, you could still think, okay, maybe that's still correlated with Help to Buy, but we tested for that. So here we look at, so the dependent variable is the number of persons moving from a different district into district D. And then we look whether that effect change, whether there's a positive effect of Help to Buy exposure on migration patterns, because that would mean that people endogenously move to high exposure areas. However, as you can see from the table, we do not find a positive. So for all districts, it's insignificant. If we exclude London, it's even negative insignificant. But if we look at London only, then it's positive significant. And it's logical in the sense that in London, it's much easier to move between areas. But since all our results hold when we exclude London, we also know that our main findings are not driven by this internal migration story.
Very good. There's a couple more questions. I realize we're a couple of minutes over time. So if you need to...
No. I'm happy to...
All right, that's really good. So I'll read them both to you. So the first one is by Mike Guan, who asks, well, again, thanks you for a great presentation. Could you please explain one more time how you distinguish between the extensive and intensive margins? And then there's a question from Edward Gaffney, who asks, are you aware of any research to distinguish consumption growth of cars versus other white goods due to households growing in size by having children, a clear cause of higher consumption, which is very correlated with home ownership and moving?
Yeah, that's going to be our next paper.
You've got to wait, Edward. Sorry.
Yeah. So let's start with the extensive and the intensive margin. So we don't test explicitly for the intensive margin. We just by showing that there is an increase in home sales, we know that it has to be driven by the extensive margin or the timing effect. Because the intensive margin effect basically means you already wanted to buy a house. You just, instead of buying a house that's 100,000, you buy now a house at the same time, but you buy now one of 200,000. So in terms of number of houses purchased, there is no change. It's just they become people buy more expensive houses. If there is a positive significant effect on the number of houses purchased, then you know it has to be either renters moving into buying, or, so that's the first time buyers, or it's driven by people that already had a house and now start to, instead of buying a new house, say 2 years from now, they now buy one at the moment. So that's why we know, that's how we differentiate between the two. On the consumption, it's a very well taken point. Is that once people that own a house or can buy a house, we think, and we have some initial evidence already in favor of that also has a positive effect on fertility, on people having children, and that at the same time then makes people often more likely to want to buy a house, buy a car. So that's one of the channels that might be going underneath the car purchases. We do control in the regressions for the number of people that live in a household. So we do. So it's not, that is not at least in the consumption part, that's not what's really driving our results. But in the car sales part, we cannot control for that. So it could be that the two go jointly together. Definitely.
Very good. All right. Last question. This is again from Tim Foreman, who says, I think I was wondering this one as well. So he's curious why we might see an increase in 10% down payment loans. It seems like the option of having a 5% down payments might decrease these types of loans.
Yeah, no, it's that is particularly driven by the equity loan scheme. Because with the equity loan scheme, people have a choice how much they put in down payment themselves and how much the equity part of the bank is. And so you can move a little bit. And I haven't studied the equity loan scheme in detail, but I do know that the majority of people, so there is a very interesting paper of some colleagues at the bank who look at the equity loan scheme and how much down payment people put down, and the majority do 5%. There is a significant amount of people that choose to take a 10% down payment. What that really is behind it, I don't know. I guess is that they don't want the government to own, or because if the government owns 20% equity, it also gets 20% of the house price growth. So if you have more, you probably want to put in more deposits. So that could explain why there is also some positive effect on the 90 LTV that we done.
Very good. This was fantastic, Neeltje. Thank you so much for generously kind of answering all the questions, and really for a very
thanks for the great questions.
Brilliant. We will invite you again for the next paper, which you highlighted for us. So I'll just thank you one more time, Neeltje. I think the kind of number of questions is testament to how interesting the audience found this. And I'll just say our next talk in 2 weeks' time is Michele Lenzer from the ECB. So I hope you can join us for that. Thank you once again, Neeltje.
Thanks a lot, David. Pleasure to be here.